Welcome to CoreLogic's housing market update for May 2020, brought to you by onthehouse.com.au. As the world focuses on containing the COVID-19 pandemic, I hope that you and your families remain well and safe. Housing markets have been impacted by the sudden weakness in economic conditions and a plunge in consumer sentiment. However, there has been a significant contrast between housing values, which have shown some resilience to falls, and market activity, which has dropped sharply through the second half of March and April. Most regions recorded a rise in home values through April. However, the monthly pace of growth more than halved, dropping from 0.7% in March to 0.3% in April, which was the smallest month-on-month movement since July last year, when the national index was flat over the month. The 6 months prior to March saw national housing values rising at the average rate of 1.1% per month, highlighting how fast the growth has left the market. Although housing values were generally slightly positive over the month, the trend has clearly weakened since mid to late March, when social distancing policies were implemented and consumer sentiment started to plummet. The sharpest reversal in growth conditions can be seen in Melbourne, where housing values nudged into negative territory through April, down 0.3%. Growth in Sydney values has also slowed sharply but remained positive, rising 0.4% over the month. To provide some context, the 6 months prior to March saw both cities averaging a nation-leading monthly growth rate of about 1.7%. Hobart was the only other major region to record a decline in home values through the month, down 0.1%. Hobart has the most exposure of any capital city, at least proportionally, to the industry sectors that are most heavily impacted by COVID-19 in terms of employment, with 12.7% of the workforce employed in the accommodation and food services sectors and the art and recreation sectors. Despite the weakening in housing market conditions, some cities have outperformed the 6-month average. Perth, for example, saw values rise by 0.2%, Adelaide was up 0.4%, and Darwin values were 1.7% higher over the month. Each of these cities has shown a larger gain relative to the 6-month average in April, demonstrating some resilience to weaker conditions. Other indicators of housing market conditions haven't been as resilient. CoreLogic estimates of settled sales plunged by around 40% in April as buyers retreated to the sidelines and listing numbers dried up. The substantial drop in sales activity is supported by a similar fall in the number of mortgage-related valuation events across the CoreLogic platforms, which account for about 85% of lender valuation instructions. Additionally, activity across CoreLogic's RP data platform, where the large majority of real estate agents undertake the research to prepare a property for sale, was down by about 60% prior to Easter, providing a firm signal that industry activity has been hit hard by the drop in active buyers and sellers, as well as policies preventing open homes and on-site auctions. Encouragingly, real estate agent activity did show a partial bounce back after Easter to level out around 40% below the same time a year ago. The decline in real estate activity is also showing up in the number of new listings being added to the market, which was tracking about 35% lower at the end of April relative to the same time a year ago, and 43% below the 5-year average. The reduction in advertised stock levels at a time of low demand is one factor that should help to insulate housing values from a more material downturn. Let's take a look at how housing market conditions played out across each of the capital cities. Sydney has seen the rate of capital gains drop from an average of 1.7% over the 6 months to March down to 0.4% in April, continuing a weakening trend that became apparent around mid-March. Policies restricting open homes and on-site auctions have recently been lifted, which could see activity across the local market pick up. However, some downside risk remains due to Sydney's exposure to overseas migration as a source of housing demand, as well as the likelihood that consumer confidence will remain at low levels. Rental markets are likely to see weaker conditions due to the reduction in migration rates and less student demand, as well as a short-term rental stock transitioning into the permanent rental pool. Sydney rents were down 0.7% over the month, dragging the gross rental yield to a new record low of 2.9%. Melbourne home values were down 0.3% in April, the first month-on-month fall since May last year. The monthly fall comes after a strong rebound in housing values since June last year, which saw Melbourne dwelling values reach a new record high in February. Melbourne has relatively high exposure to overseas migration, which is likely to be one of the factors behind Melbourne's weakness, along with the policies restricting on-site auctions and open homes. Melbourne rental rates were also down over the month, falling by 0.5%. Rental markets are likely to experience weaker conditions relative to home values due to higher supply of rental properties and less demand. Brisbane home values continued to edge higher in April, up 0.3% over the month. Although values were higher, the rate of growth has halved relative to the 6-month average rate of growth prior to COVID-19. With less reliance to overseas migration as a source of housing demand and the largest number of interstate migrants, the Queensland market may be less exposed to downwards pressure in housing values. Rental markets have started to see some weakness though, with rents down 0.4% in April, reflecting a rise in rental supply as well as a reduction in demand. Adelaide was one of the few capital city markets where the pace of capital gains in April was higher than the 6-month average. Values ticked 0.4% higher over the month, continuing what's been a relatively steady and sustainable pace of growth that's been evident since September last year. The rise in values was broadly based, with each of Adelaide's sub-regions recording a rise in home values over the month, led by Adelaide West, where values were 0.9% higher in April. New listing numbers were down 38% compared with a year ago, reflecting a substantial drop in advertised supply levels, and rental markets softened, with rents slipping 0.1% in April. Perth home values have avoided a fall for 6 consecutive months, which is the longest run of growth since the market peaked in mid-2014. The April figures showed a 0.2% lift in values over the month, taking the market 1.1% higher over the year to date. Local rents also edged higher, rising 0.1% in April, with Perth the only capital city to avoid a drop in rents over the month. Despite the positive monthly reading for values and rents, it's clear that activity has reduced. New listing numbers are down about 46% compared with a year ago, and our estimate of buyer numbers has more than halved over the month, suggesting buyers and sellers have retreated to the sidelines. The Hobart housing market has recorded 2 consecutive months now where values have slipped lower, down 0.2% in March, followed by a 0.1% fall in April. From an economic perspective, Hobart's labour force has the highest exposure of any capital city to the most disrupted industry sectors, with almost 13% of the workforce employed within the accommodation and food services sector or the arts and recreational services sector. The previously strong rental conditions have also reversed, with Hobart rents down 1.1% in April, the largest drop of any capital city. The weaker rental market conditions may be attributable to a supply shock associated with the large supply of short-term rentals transitioning to permanent rentals. Darwin home values bounced higher in April, up 1.7%, which followed a 2% lift in March. Considering the weak trend that was previously evident across Darwin, as well as the challenges related to COVID-19, an abrupt shift to a significant positive change is unlikely, with the recent lift in home values probably more attributable to volatility resulting from low sales than actual gains. If the CoreLogic indices continue to show a positive turn in the Darwin market over the coming months, that may provide some firmer evidence of a market turnaround. Our measure of new listing numbers is down almost 60% compared with a year ago, reflecting a significant reduction in advertised supply levels. Housing values held firm across Canberra in April, with a 0.1% rise in house values helping to offset a 0.4% fall in unit values. As consumer sentiment weakens, we've also seen a drop in new listing numbers, which were down about 18.5% in April compared with the same time a year ago. And our estimate of sales activity was down 38% over the month. Looking forward, Canberra may navigate the COVID-19 disruption better than other cities due to only a small proportion of the workforce being employed within heavily impacted industry sectors. Only 7.9% of Canberra's population are employed within the accommodation and food services sectors or the arts and recreational services sector. In the context of rapidly weakening economic conditions and the broader COVID-19 related disruption, the April housing market result looks remarkably resilient. The Australian version of this global health and economic crisis is only a month and a half old, and it looks inevitable that there will be some downwards pressure on housing values over the coming months. The magnitude of falls depends on a broad range of factors, with most hinging on the timing and the extent of social distancing policies being lifted. The good news is that Australia has managed to flatten the spread of the virus much more effectively and efficiently than expected, and we're already seeing signs of an easing of social distancing policies in some states. An early return of economic activity should support a lift in consumer spirits, which in turn should see housing market activity sparking back to life. Plenty of downside risk remains for housing values. However, there are a variety of factors that will help to insulate home values from a material downturn. A key factor is the leniency provided to distressed borrowers affected by COVID-19 by Australian banks. Eligible borrowers can take advantage of repayment holidays over a 6-month period, by which time the economy will hopefully be in better shape. This policy is central to limiting the flow of distressed properties onto the marketplace, which could have otherwise been a source of more significant downwards pressure on home values. Additionally, the anticipated high rate of unemployment is likely to be most impactful on areas of the workforce that have lower rates of home ownership, which is another factor that should help to keep the number of distressed properties to a minimum. There's also the unprecedented level of stimulus to consider, which will help to keep businesses afloat and workers in a paying job. A sharp reduction in advertised supply levels is another factor helping to safeguard home values amidst a fall in buyer demand, as well as record low interest rates. No doubt the coming months will provide more clarity about the direction of housing markets. One of the most important indicators to follow will be the measures of consumer sentiment. If consumer spirits do start to bounce back to more normal levels, this will be a firm sign that consumers will be more able to make high commitment decisions like buying or selling a home. CoreLogic will be tracking all the twists and turns in the housing data on a daily basis. You can tune into our research at www.corelogic.com.au.